Okay, good day everyone. This is Mapletree Logistics Trust fourth quarter FY 24-25 financial results dated 23rd April 2025. Right, we look at the fourth quarter key highlights year on year. That means compared with fourth quarter last financial year. Right, revenue is down 0.8% year on year. NPI is down 1.6% year on year. DPU is down 11.6% year on year. Right, clearly not a good result. Right, occupancy is still relatively high at 96.2%. Alright, rental reversion is better than last quarter, which is third quarter, where it was 3.4%. Now it's 5.1%. So it's a slightly better result than last quarter. Right, debt is pretty high, 40.7%. Right. We look at their divestments, which again they are doing well, right? This is something that is a recurring theme, right? They sell these Malaysian properties for 11% above valuation, right? A Singapore property 6.8% above valuation, another Malaysian property 31% above valuation, and finally this Tuas View Square, right? 39.8% above valuation, right? So they're still selling properties well, right, at a profit, right? Hopefully they're not overpaying for the properties that they are acquiring, right? So fourth quarter this financial year, which is the latest one versus last year, right? You can see everything is bad. Revenue is down, net property expense is up, NPI is down, borrowing cost is up, right? Which is unsurprising that why the results for amount distributable is down 10%, so bad, right? The only good news here is perpetual securities, they somehow paid off some, so there's less to pay to perpetual security holders now, which means that there's more to unit holders as a proportion, right? But still, amount paid to unit holders is down by 10%. Right, so available DPU is down by 11.6%. However, you strip out the one-off divestment gains, right? The drop is 8.5%. Right, so it's slightly nicer than the 11.6%. Right, why revenue is lower contribution from China, which has been happening for quite a while. Right, obviously they divested some properties, and currency weakness is a recurring theme for this REIT that is quite exposed to foreign currencies, right? Mitigated by Australia, Singapore, and Hong Kong, right, which are doing well, and of course acquisitions have started to contribute more, right? Currency, some of it they hedge, right, to reduce the impact of currency weakness from overseas, right? Property expense went up, right? Not a good thing. Higher utilities, property expenses, maintenance expenses, and acquisitions, right? All these things increase, right? Of course, offset by divested properties and currency weaknesses. Borrowing costs increase due to higher average interest rate on existing debts, right? And incremental borrowing to fund first quarter acquisitions, right? Yeah, I was just writing here, why don't pay down more with divestment gains rather than keep distributing them, and they have been doing this for a couple of quarters. I'll show you later, right? What else do I want to say? Yeah, there's some hope for the borrowing costs, right? Remember this quarter, fourth quarter versus fourth quarter last year, right? We'll look quarter versus quarter results to have a closer view. This one year on year I won't cover this because actually we cover quarter by quarter, which is more current now. Okay, so yeah, this fourth quarter this year versus the latest quarter, which is third quarter the same financial year, right? Revenue down, property expense up, net property income down, borrowing costs down, right? So this is actually good news, right? You see just now it's fourth quarter versus last year's fourth quarter. That's why the borrowing cost is up, right? But actually borrowing cost in the most recent quarter, recent two quarters versus the latest quarter is actually down by 3.1%, right? And I'll show you versus second quarter how does it look like, right? So this second quarter borrowing cost is actually flattish already. It went up by 0.3%, right? So you can see borrowing cost relatively constant. This is third quarter versus second quarter, and if you look at second quarter versus first quarter, I think borrowing cost is up 3.6%. Yeah, so you can see that the trend of borrowing cost is stabilizing, right? It's 3.6% in second quarter. Let me check first quarter. Yeah, first quarter borrowing cost, yeah, went up. So first quarter this financial year went up 3.3%. Second quarter 3.6%. Third quarter more or less flattish, and fourth quarter finally is down, right? So actually the trend of borrowing cost is going down, right? So this is a good thing, right? This is a positive I see in the REIT. These numbers I think not too much to say. Amount distributable down 2.2% quarter on quarter. Not a good result in terms of distribution clearly, right? Without dividend gains, it's worse. All right, it's down 2.8%. Yeah, I think the rest I won't talk too much about. Yeah, so borrowing costs decreased due to lower average interest rate on unhedged loans and loan repayments using divestment proceeds, which I think they should have started doing quite a long time ago. Yeah, they started doing this I think in second quarter, right? Let me see. Did they say? Yeah, the second quarter they started paying off loans from divestments really. I think first quarter they didn't write this. First quarter also. Yeah, okay, so they started paying off loans from divestment since first quarter at least. Right, so yeah, that's a good thing lah. Right, let's look at balance sheet. Right, not that great, right, because the leverage ratio is going up. Right, interest rates on average is still flattish. Right, interest coverage ratio is below 3, which is not that good in my opinion. Right, next FY we have about 7% of the debt to refinance. I don't think they will have a problem refinancing. It's more about what's the interest rate. Right, so they have a lot of cheap debt from Japan and renminbi, right? So positive for the REIT, right? Not so concerned about these things, right? I just did a short valuation exercise. If I base off the latest distribution amount, which is the fourth quarter one, which I believe should be the lowest among the whole year, right? I multiply by 4 to be conservative, right? So this annual dividends, assuming that this holds, right? It's about this amount, 7.82. I think the price yesterday was 1.12. I'm not sure what the price today is. Sorry, I didn't check. Right, so it's about 6.98%, which is a pretty good dividend for this REIT because if you look at retirement's website, right, I think 7% is something like 2 standard deviations above the average trading dividend yield for Mapletree Logistics. All right, I'm not saying that you should buy, but I'm just saying that historically is quite valued quite cheaply at this point. Right, but cheap normally got cheap reasons as I'll discuss later. Right, so if you look at assets under management, valuation and revenue, I would suggest that Singapore properties may be undervalued, right, because it gives 20% of it's 20% of the assets under management, but gives 27.7% of the revenue. Right, Hong Kong on the other hand may be overvalued right, 23.3% but 17% of revenue only. Right, this is something interesting. We'll always worry about Mapletree Logistics, whether they are exposed to the Tariff Wars. I think this is the answer to the question. They say majority of tenants, estimated at 85% of revenue is serving domestic consumption, which most likely won't get affected by the tariff because they say tenants engaged in export business account for around 15%, right? That means the 85% most likely is relatively shielded from the tariff war with the US, right? So I think that is a good thing. All right, occupancy wise, you can see mostly above 95%, but I think China still has issues You can see it's below 95%, right? And I think they are dropping the rates in China just to keep the warehouses there filled, right? So anyway, moving on. Rental revisions positive across all markets except China, which has been going on for a while. Right, you can see Singapore slightly worse than last quarter, Hong Kong as well. Right, Japan, this one is a one-off that apparently is 20 years ago. So actually, 19.4% rental revision. Yeah, 20 years ago, 19.4% rental revision. So not very impressive right? So that's like 1% a year or something. Right, that's a very very rough calculation. Right, so South Korea and Malaysia slightly better. China, you can see, are still negative and they expect this to continue. Right, so don't expect turnaround anytime soon. Right, fundamentally the portfolio and ex-China rental revisions is slightly better than third quarter. Right, not going to talk so much about this. Yeah, I don't think I'll talk about this also. Is there anything else I wanted to talk about? I think the outlook, yeah. So rising trade tensions and recession fears have heightened business uncertainty. Short term, tenants are likely to stay cautious. Right, longer term, a protracted trade war will dampen economic activity, investment and consumption. Right, of course, it could impact warehouse demand, occupancy and rental rates. Right, so I don't think rental revisions in the short term are going to look very good. Right, because tenants currently should be worried about the economy and about a potential recession, and the 85% will worry about potential recession. The 15% exposed to exports will worry about tariffs, right? Because I was listening to some podcasts lately where they they said that in the US, right, some of the businesses, where they import the China goods, for example 70 million worth of China goods, right, when it come to the dock, right, the boss has to call the finance officer to say, hey, can you get an $80+ million loan just to pay the tariffs because the tariff is so absurdly high, right? So this effect is such that the boss actually called China and say, hey, for now don't actually carry on manufacturing goods for me because I can't afford to pay. And the boss actually can come up with the $80+ million to pay for the tariffs, right? So I don't know what's the end of the story, but clearly the production would have dropped in China because of this export tariff wars, right? So clearly economic activity will be dampened both in the China as well as in the US, probably because of inflation, right? Inflation of the cost of living, right? So all these things, nothing much to say lah. It's like very standard stuff that every REIT manager will say. Alright, so the worry is next FY there's a high percentage of China stuff to be refinanced. Expected that this will still be negative lah. So is DPU expected to drop? My suspicion is yes, right? Even though cost of debt, they finally managed to bring it down, right? So don't expect performance to turn around anytime soon, right? But valuations are looking more and more interesting lah. For me, I might be interested maybe closer to $1, right? None of this is financial advice. I will have to relook again when it's $1 lah, right? So that's all for my sharing. If you do feel like you learned something or you benefited, do give me a thumbs up, right? No financial advice is given in this recording, right? And thank you very much for listening.